Position sizing is one of the most important factor when it comes to risk management. If you're a trader who is interested in having to trade responsibly and not going in full margin, then having to determine the amount of money you're willing to lose in a single trade is the foundation of risk management. Now the question is, in as much as simple as that sounds, my experience with a lot of starting traders is that actually they don't know how to position size. I've gone to live trading sessions online where I see people asking in the comment section, how much did you determine? Uh, how did you determine the lot size to buy at this position? If I'm only willing to lose this amount of money, how will I determine that? And it's the easiest, but again, it's one of the most ignored thing in risk management because most traders who trade live, especially those who trade gold, will go on and clicking zero point 0.1 probably 100 times. And well, it works for some, but in reality, when you're a beginner trader, you're going to blow your account if you follow that kind of model. So the best thing is to determine the amount of risk you're willing to, the amount of money you're willing to risk in a trade. And then from there now, you can calculate how much you should buy, how much units of currency you should buy. And this is a basic aspect of anything that we do in life. If you have money, for example, you're going to buy veggies, you're going to buy groceries, you already know how much you're willing to spend. Then now you ask the price, and then now you determine how much you're going to be given based on the amount you're willing to give the person who's selling grocery. For example, if you're going to buy 10 tomatoes, then you're going to ask, probably you decided I want to buy tomatoes worth 100 shillings. Then you're going to ask how do you sell tomatoes? Then they're going to tell you I'm selling probably 20, either it's 20 shillings, $20, or I'm selling this amount of this number of tomatoes for this amount of money. Then you're going to now give the money and they're going to calculate how much tomatoes you're going to get. Why can't we do the same when it comes to forex trading? Now, in this video, I'm going to demonstrate how you can position size, whether it's a small account or a big account. But remember, I'm not considering the margin requirements in this case. I'm assuming that your account size allows for you to buy this amount of units of lot size. Probably the next video, I'm going to now explain in details how much now you can know if your account size your account size is sufficient to buy certain number of units of currency. And remember, the units of currency are measured in lot sizes. And another assumption in this video is that you're going to use standard lot size. But remember, in different brokers, you can have standard account, you can have mini lot accounts. So it's, in this case, I'm focusing on standard account, whereby let me just come here. When you come to such a place, you can see the smallest unit you can buy is 0.01 lot size, which means the broker I'm using on this particular account is using a standard lot size. Now, I'm going to do this video on the basis of a small account, and I'm going to assume that you as a trader, you're going to risk $10 per trader, assuming that you have probably 1,000 account or $100 account, and you want to be risking only $10 per trade. That means if the price goes against you for $10, then you're going to willing to let go of the trade and move on. Now, let's assume now you have $100 account, and it's a small account. Of course, you are risking probably large amount of money, probably 10% of the account, which is $10, which is a lot in real sense. But for a good trader, you can survive with it, because even in prop firm, when you're risking 1%, for most of the time you're risking either 1% or 1.1, 1.5, 1.14% of your account, or the amount you are allowed to lose in terms of maximum drawdown. So let's assume, and I'm going to use probably different currencies to demonstrate. But in this case, remember, one of the most important factors is when you're position sizing, you are considering market structure as the foundation of your SL placement, because your stop loss is not placed anywhere. It's placed on the basis. The market structure determines how large or how small your position size is. Now, in the for this example, I'm going to use this outcome. Let's assume, because, and I'm going to just give a general summarized view why I think that should probably be the case in this case, probably in terms of how, why probably will be selling at that point. So let's come for example, you're a market structure trader, you come on H4 on Audicard tomorrow on Monday, you realize it's that downtrend. You come on H1, you realize still the trend is down. Okay, trend has slightly shifted here, but you are seeing supply here. Then you want to now sell at this supply zone. Remember, I'm not saying, in this case, my focus is not whether I'm going to sell at that position. My focus in this case is I'm assuming you've determined that you want to sell. So the focus is not whether I should be selling at that position. For in terms of analyzing market structure, now I think I should have bought or sold at this particular zone, then it's a different video. But this, for the sake of this video, I'm going to focus on position sizing. So, assuming that you want to use a pending order, you've determined that this is my supply zone, so I want to use a pending order. Now, pending order, I want to assure that I want to get in here. Instead of waiting for confirmation, I just want to place a pending order. So, when the price comes here, I'm going to place my pending order, then probably now target somewhere else, but I want to ensure that my stop loss is above this place. Now, what I'm going to do first thing when you're going to position size, number one, you have to determine the number of pips of your SL. How large is your position, your stop loss? So this is the order block. So you'll come probably take you will take this crosshair, measure the pip size. So when you pull up to the end of this place, you can see it's 158 points. 158 points is 15.8 pips. Now, remember, it's good to add the spread when you're position sizing, because remember, if you're selling, then your stop loss should be above this zone by the number of pips of a spread. So assuming that your spread is 1 on your broker, because the broker differs in terms of spreads. So let's assume for the broker I'm using, of course, the spread on this is almost 0.01, so it's negligible, it's small. So I'm going to assume that now, because it's 15.8, I'm going to assume that now this size is 16. Now I'm going to take my number of pips to be 16. Now I've measured. The first thing to do is you measure the number of pips of your stop loss. Now 16 pips. The next thing, you can go to online, and I'm going to use different online tools. Probably I'm demonstrating too. And remember, I'm not affiliated to any of this. I'm just using them. They're free online tools. So you can just Google, even if they're not this one. So assuming that I come to this one called earnforex.com. My account size is it's in USD. You come here, risk ratio. Remember, there are a lot of ways of playing around here. Remember here, let's assume my account is $100. I'm going to put in $100. Here, I want to risk, if I have to risk $10, then $10 is 10% of the account. But if I don't want to go into those deep mathematics, I can just say I want to risk $10 of my account. And if I'm risking $10 of my account, then that is 100% of that account. So one, I can place my whole account here and then calculate the percentage. If I want to risk, if it's $1,000 account, for example, and I want to risk $10, then that is 1% of that account. But if it's a $100 account, then I want to risk $10, then it's a 10% of the account. If I don't want to go into those details, I just take the amount I want to risk on the account, which is $10, then say I want to risk 100% of this $10, which means entire. Then what is the stop loss size? 158 pips, and we said we're going to 158 points, which is, we said we're going to approximate them to 160 points, which is 16 pips to cater for spread. Then I just change here. What is the currency I'm using? Audicard. So you come here, you say my pair is Audicard. Let me see if I can just search. Can I type Audicard? It's not. So you ensure that you choose the pair. Let me see where it is. I'm not seeing it yet. D Euro USD. Audi card. Is it there? Okay, here it is. Here. So our stop loss size 16 pips. $10 the amount I want to risk, so I'm risking the entire $10. Then I click here, calculate. Now, units is how many units? 1,000 units, but 1,000 units is 0.1 lots. So when I come here it will be 0.1. Now, when I click, if the market was open and I clicked sell at this position, when I now drag my stop loss to this position, you'll see it will be $10. So you can do that with every pair. For example, if you come, let's just go to another pair. Let's assume it's Euro USD, and we go just say you want to sell why it is exactly what it is you want to sell. So you just calculate. Probably you want to place your stop loss here, here. So, and you want to enter exactly what it is you're going to put here, mesh here, and realize this is 43 points, which is approximately 4 pips. So including spread for this broker it's 0, but let's assume you have probably 1 pip, so you can bring it to 5. You'll just come here and say my currency pair is Euro USD, and choose Euro USD. Say my stop loss size is 5, and the amount risk $10, and say calculate. And then you're going to realize you're supposed to sell 0.2 units. So I'm going to come here, which is 0.2 lot size. Then if you click and drag, you're going to realize when you get here, it's $10. Now, when the price goes against you and goes past this zone, then you're going to lose exactly $10. And that is the foundation of risk management. You can do that with different tools. If you come to this tool called, I think it's a1trading.com, you can do the same. You can also choose a pair here. You choose your pair. You can decide the stop loss size. You can choose the account. You can choose the percentage. Even on the phone, so actually on the phone that's simpler. You can even go to Play Store or on Play Store if you're using Android device, or Apple Store if you're using iOS. Then now can just Google position sizing calculator. You can add FX position sizing calculator, and that is the foundation of position sizing. If you don't do that, then you'll be messed up big time, because the trading that you see on social media where people are going on gold and clicking 100 position, well, it looks fancy and you can get a lot of money at once. But remember, if you do such a thing and get a lot of money at once, it sounds good, but unfortunately the same way you got that a lot of money at once clicking 100 positions of gold or any pair, if one day price goes against you, also remember you're going to lose also a lot of money at once. So I would suggest position sizing and having to accept that having to refine your revenue curve to grow slowly, while at the same time collecting data and refining your entries, and having to project long term as opposed to a lot of money in one, probably in FP news, or but that is your decision to make. So in case you want to learn more about position sizing, you can reach out. There's an email in the description section. You want